Jerome Powell weighing in on the state of gold, saying the U.S. should not return to gold standard. But at his testimony on the Hill yesterday, he compared gold to Bitcoin.
Bitcoin is a good example. Really, almost no one uses Bitcoin for payments. They use it more as an alternative to gold, really. It's a store of value. It's a speculative store of value, like gold. So we don't have, and people, of course, have been talking about this since cryptocurrencies emerged, but we haven't seen it. But that's not to say we won't see it. And if we do see it, yes, you could see a return to an era in the United States where we had many different currencies, and in the so-called, I guess, national banking era.
Off of that testimony, gold remains in the green this morning. And here with us now is the Director of Research at the World Gold Council, Juan Carlos Artigas. Juan, thank you so much for being with us. I just want your reaction to what Powell said. So in the past, he has said that the U.S. should not return to the gold standard, and some took that as a call to drop gold and buy Bitcoin. Would you see it that way?
Look, I think that there's kind of like a difference here. We don't think that it's very likely that we will return to a gold standard. And there are many reasons for that. I mean, you are indeed, when you are backing currencies by gold, you're pegging the prices of two assets. And economically, that can be difficult for many reasons. However, I think that the role of gold in portfolios, whether it is for investors or for central banks, goes well beyond that. And I think that it's actually not correct to compare gold to Bitcoin. It's done very often. Actually, it's different. I think that the main similarity between the two is the limited supply aspect of it. However, what people perhaps don't understand as much is that about 60% of physical demand is linked to jewelry or technology, right? So there's a productive
that's real and you can touch, right?
Why are you even still talking about the gold standard? Clearly, it sounds by your comments, it doesn't apply anymore. Can we just put it to bed?
Look, I mean, I think that to some degree that can be that comes up a lot, and there are reasons sometimes why it comes up. In part, it is because you have monetary policy that is very easy. It creates a huge money supply, and so people get concerned that is difficult later on to rein in. Again, more importantly for us, we do think that there's a really important role that gold plays in portfolios, whether it is of investors or even central banks.
What have inflows and outflows look like now we're at the midpoint of the year for ETF-backed gold ETFs? That
has been actually really strong. Year to date, worldwide, there's been about $5.3 billion going to gold-backed ETFs. And what is interesting as well is that about 70% of those flows are going to Europe, right? So 5-7 years ago, conversations about gold-backed ETFs were primarily centered in the US, North America more generally. By now, actually, European gold-backed ETFs are more or less par and par with respect to the assets under management relative to US and North American assets. And if you think about it, it kind of like makes sense. European investors are facing negative interest rates in nominal terms. Yes. They are facing also a lot of kind of like uncertainty. There's Brexit, there are issues with the EU, and many of them for Europe. Some of the geopolitical risks that investors are facing feel a little bit more systemic to them than perhaps they feel in U.S. investors.
And it seems to be we are right on the cusp of one 25 basis point rate cut and maybe two more before year end. What does that mean for gold prices?
Generally speaking, when you look at gold and gold's performance, there are four key drivers: economic wealth and expansion, and I'll talk about it later. Market risk and uncertainty, which is something that people think about a lot in terms of gold and how it reacts, especially in times of recession. Then there's the opportunity cost aspect and momentum, which are more tactical. So interest rates influence opportunity cost. It lowers opportunity cost and tends to be supportive of gold demand. What we've known, or through our research or what our analysis shows, is that in periods of negative interest rates, which again, if the Fed were to deliver on the 2 to 3 cuts that we may get, gold returns tend to be twice their normal average, their long-term average.
What's your outlook for where does gold end the year? We're about 1,400 right now. What's your outlook?
We don't forecast the price of gold. What I can tell you is that the environment right now is quite supportive of investment demand, even if there is a little bit of softness on consumer demand.
All right, well, we'll leave it there. Appreciate it.
Thank you so much for having me.